Hey there, it's Ted Thatcher, president of Bright Lake Wealth Management, and I wanted to bring you another market update. Of course, there have been a tremendous amount of geopolitical headlines lately with all of the strife in the Middle East around, of course, what Israel and Iran have been going through in terms of their conflict, and of course, the additional response that the United States has taken in the region to essentially dismantle and destroy the different nuclear plants and things. There's been a tremendous amount of reporting and headlines around, what's occurred. Some of them are more extravagant, saying this is going to lead to World War III. Others, of course, outlining just the real effects on the ground. And in terms of the financial markets and the consequences there, there's been really a concern around two things. Primarily, of course, the cost of energy. There's so much oil produced in the Middle East. Rising oil prices has a very second order effect in terms of inflation by raising the cost of production for goods and services across the globe, actually. And so it's been actually a very good thing as this the temperature in the Middle East has wound down. We aren't seeing World War III. In fact, when a war like this kicks off between such significant powers like the United States, you would expect actually a lot of volatility in the equity markets and stocks. And really, the market was looking at this and saying, we don't really think that this is going to go the distance. This isn't going to be World War III. You could see that in really, maybe there was some volatility, but no huge drop off a cliff like you've seen in the past when there's been geopolitical conflicts. Additionally, the sort of second concern there has been that potential for rising costs of energy, again, because there's so much oil produced in that region. We did see oil prices spike up slightly, but even since the beginning of that conflict, oil prices are actually now flat to down. And so ultimately, the ceasefire has been a good thing, of course, and we don't really think that that's going to have tremendous additional waves in the financial markets at this point. We are also separately, still watching everything going on with the tariffs. Actually, tariff revenue for the United States last month in May was up to about $22 billion, about 2 times as high as it was in February. And so we are seeing some revenue come from the tariffs. From a policy standpoint, the administration wants to see that. However, we still have not seen a big pen to paper when it comes to an ultimate perpetuating Chinese trade deal and things like that. I will say, given everything that happened around Liberation Day or in early April, I do think that most of the tariff volatility is behind us unless the rhetoric really were to get jacked back up again. So we'll continue to monitor the progress there, but that is where it sits today. Further, we've had this ongoing discussion about really what's going to be happening with the economy throughout the rest of the year, what's going to be driving the financial markets. And I think ultimately it comes down to really, what are the economic vital signs of the country telling us? We just had GDP releases come in higher than expected, which is really good. The country is producing more than we would expect it to. Inflation has been trending in the right direction. The CPI is reporting inflation at 2.4% year over year. Again, coming down toward that 2% number that we really want to see and really what the Fed, Jerome Powell, is looking for when it comes to interest rates and the potential for lowering those. So we're seeing good economic data on those fronts. And further, we're seeing consumer sentiment about their own financial situations actually grow. It was on a downward trend for quite a while, and it's actually made a marked improvement the last 2 months or so. And so we're seeing things trend in the right direction for the fundamentals of the economy right now. And ultimately, hopefully, we'll see that perpetuated throughout the rest of the year in terms of stable and ideally growing financial markets. The question mark we are still waiting on right now is what's going to happen with the big, beautiful bill still sitting and working its way through Congress. I do believe that it will pass with much of what is currently contained in there, specifically around the tax cuts being codified. And when the market sees that pass, I think it will breathe a little bit of a sigh of relief. So much of what the financial markets price in is, based on, of course, the fundamentals. So the revenues, the costs, how much deficits are we spending as a country and those types of things. And so we'll have more clarity around what types of numbers we'll see based on, of course, the tax legislation that's going to be truly codified, and it won't be an assumption any longer. Finally, the last economic vital sign I'll highlight for our market update here today is actually the jobs numbers. We have a close eye on what the labor market is also telling us about what's going on in the economy. And right now, the unemployment rate has been in the low fours for literally the last 12 months. And the most recent report for initial jobless claims came in even further below expectations. And so ultimately, we're seeing an actual strengthening of that trend toward a continued low unemployment rate, which also speaks well for the stability of the economy and stability, generally speaking, for the financial markets. So while it has been a very volatile start to the year, hopefully these signs are actually pointing us towards a little bit more stability. Of course, depending on what happens around the world and what happens with new policy that we may, not know about yet, that can always throw a variable into the financial markets for it to process. But we'll continue to monitor that and keep reporting back to you. This has been your market update from Ted Thatcher, president here at Bright Lake Wealth Management. We'll see you next time.